Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, National Underwriter for Old Capital, Paul Peebles, and of course, joining me today is Michael Becker. Today's podcast, I think, is going to be one of our best. We have an underwriter for Fannie Mae, a DUS lender, in the studio. He's going to talk a little bit about Fannie Mae and Freddie Mac, and it's going to be a great conversation. I think you'll really enjoy his 30 years of experience about multifamily underwriting. But before we do that, I want to visit a little bit about an issue that I think is very important in multifamily, is just an NOI. And everyone focuses on, income minus the expenses equals the NOI. We always try to focus in on trying to get higher NOI, and we always think it's probably the top line with the revenue income coming in, but sometimes we fail to focus in on the expense side. So I want to talk a little bit to Mike about the expense side and how can we improve or lower the expense side. Mike?
Sure. One of the things that we observe when we're seeing a lot of our clients out there that they're successful with is doing things to reduce some of the expenses. Like you mentioned, when everyone's looking at a value add multifamily property or just any property, they're always looking, can I raise rents? Can I increase my bill backs? And a lot of them fail to do as good of a job looking at trying to do some expense reductions. One of the low-hanging fruits, especially on these older properties, the Class B and Class C older properties, is implementing a water conservation program. And what a water conservation program is you can go in and hire a vendor to go in through every one of your units and fix any sort of active leaks, change out the shower heads with low-flow shower heads, put aerators on the faucets, and really can come in and even reduce some expenses 20, 30, 40% in some cases. Wow. On these older properties. Some of the other things that are pretty easy to do are you can go out and get vendors, brokers that can go out and bid out your trash collection service, or get brokers to bid out your electricity contracts, and they can get pricing power by being part of a larger group that you can piggyback on and save a lot of money that way as well. So those are just some easy, low-hanging fruit tips and ways you can go out there and reduce your expenses.
Great information, Mike. Let's throw it over to the podcasts. Welcome to the Old Capital Real Estate Investing Podcast. I'm Paul Peebles. Today we have really a super guest in the podcast is Tony. And Tony is an underwriter for DUS lender, a delegated underwriter servicer. There's probably about 25 DUS lenders in the United States, and Tony's group underwrites for Fannie Mae. And so I thought what we do is talk a little bit to Tony. Mike's in the podcast today. Mike?
Hey, Paul.
Tony, welcome to the Old Capital Podcast.
Good to be here. Thanks for having me.
So no problem. So Tony, I want to get a little bit of background on you, talk a little bit about the DUS program, and talk a little bit about, not only Fannie Mae, but also with Freddie Mac. And I think you're one of the most senior people in the multifamily Fannie Mae business. And I want to kind of just pick your brain, get your perspective about what's going on, what you like, what you don't like on transactions. So first, tell us a little bit about yourself.
Okay, happy to do that. I've been in and around multifamily for over 30 years now. I got my start as a multifamily investment sales broker. So I sold apartments in Austin, San Antonio primarily. In another life, I financed multifamily properties as a mortgage broker with the old LJ Melody Company, now CBRE. And now involved in the financing of multifamily with Fannie Mae. So I've seen it from an investment sales and from a mortgage banking background. And I can tell you I've been through a lot of ups and downs over the last 30 plus years. It's about as good as it gets right now. You have solid fundamentals in multifamily. You have, particularly in my area, Texas, you have a lot of job growth that's continuing to flow new tenants in. Even though we have a lot of new construction, it's getting absorbed. And then you top that off with pretty much historic low interest rates It's kind of a perfect storm, if you would. So a great time to be owning multifamily, selling multifamily, financing it, whatever the case may be. It's about as good as it gets. So I'm very happy with the dynamics in the business right now, and I wished it would continue forever, but I know that the slumps will come. But right now, it's a great time to invest in multifamily.
Yeah, well, why don't we just kind of start with what is a Fannie Mae lender and how does a dust shop work, and just kind of give us a little basic overview of that.
Happy to do that. One of the myths out there is Fannie Mae and Freddie Mac, for that matter, are lenders. Particularly in Fannie's case, that's really not true. Fannie Mae has 25 different companies that are DUS lenders, delegated underwriter servicers. They're actually the lender. And Fannie Mae is really more of a guarantor. And so if the lender closes a loan per Fannie Mae guidelines, Fannie Mae will guarantee the loan, and with Fannie Mae's guarantee, with the government's guarantee behind it, there's investors that will line up to purchase this literally risk-free, 100% guaranteed investment. And because there's such demand and because it's risk-free, the yield is lower, and then that can reflect into the ultimate interest rate as being a lower, more attractive interest rate for borrowers. So it assures liquidity in the multifamily marketplace, which helps obviously make sure there's ample housing, particularly affordable housing for folks to live at, and that type of thing. So Fannie is not a lender, they're a guarantor. If a loan goes bad, then they're at risk for it. But historically, Fannie Mae's criteria has been successfully implemented. It's conservative by nature. And the losses that Fannie on the multifamily side have seen are minuscule. They're one point in time, they're 0.2%, and I think they're just slightly higher than that, but less than 1% of the loans Fannie Mae does ever get into trouble. So it's a profitable division of the federal government on the multifamily side, and very, very effective.
So what's the difference between the Fannie and a Freddie? What's the difference between the two agencies and how they approach multifamily lending?
Actually, they're very, very similar. They will have their nuances. I would say push comes to shove. Freddie historically has liked the larger loans, the newer properties, the bigger borrowers, institutional quality type of thing.
Gotcha.
Not that Fannie doesn't like that, but Fannie historically has also accepted older properties, less quality. They'll do a C quality loan versus Freddie shied away from that. They'll do smaller loans. Fannie has historically been the go-to lender for small balance multifamily. That being said, last year, October specifically, Freddie Mac got into the small balance multifamily business, and they want to get into it in a very large way. They're hoping to do $3 to $4 to $5 billion of small balance multifamily loans, and a small balance loan is typically $5 million or less across the country.
Well, maybe you could just do a minute or two on what are the basic guidelines to qualify for a Fannie Mae loan? When someone's out there trying to do a deal, what should they know on the kind of high-level basis?
First thing is, your first deal is probably not a good opportunity for Fannie or Freddie. They want you to cut your teeth using somebody else's loan dollars, if you would, and get experience. A lot of guys I see start out with single family, and then economies of scale, they want to own, buy, a larger property, 20 units instead of, multiple single-family homes. So once you've had one of those multifamily properties under your belt for, the way we define it is 2 or more properties for 2 years or at least one property for 5 years, you're considered experienced and qualified for both a Fannie and a Freddie Mac execution here to finance multifamily. As far as other qualifications, we want to see a net worth of the borrower, and this can be, if there's multiple partners, you can add this up, but you want to see net worth equal to or certainly exceeding the loan amount, and we want to see demonstrated liquidity after acquisition of at least 10% of the loan amount. And again, that can be combined if there's multiple investors to reach that hurdle.
What about the property itself? What kind of properties is going to fit into the program?
Any form of multifamily housing, which by definition is 5 rental units or more, so 4 and below is considered single family, As far as quality is concerned, as I mentioned before, C, certainly B and A is fine, but C quality, and as long as it's trending the right direction, it's in other words, not C going to C minus or D, but even a C or C minus going to C plus or B minus is perfectly fine and acceptable. And Fannie will, really go in secondary, sometimes tertiary markets. It doesn't just have to be the big markets across the country.
What about, say, debt service and loan to value and things like that? What does Fannie Mae look for in their guidelines?
And minimum loan size, too.
Yeah, minimum loan size technically is $500,000 and up. Most lenders will probably tell you that, they really want to look at loan opportunities of $1 million and up. But by the law, it's $500,000 and up. And we want to see properties that are considered stabilized. Stabilized is defined primarily as a 90% physical occupancy for at least the last 90 days. So 90 for 90, as a lot of people call it, is kind of minimum requirements. We're looking to finance.
And that's, let me just stop you right there.
Yeah.
That's physical occupancy. How about economic occupancy?
Yeah, economic occupancy is when you factor in such things as concessions, bad debt, some things like that affect your overall performance economically of the asset. And Fannie's going to want to see 85% economic, 90% physical for at least 90 days. Further qualifications are, on an acquisition, we'll go to 80% on Fannie and Freddie, loan to value or loan to cost, whatever's less. They're on a refinance, 75%. Loan to value is definitely available. They dial it back a little bit on refinances. Debt coverage. Freddie is new to the small balance business, and they will go down to 120 in strong markets, but typically it's a 125 debt coverage at a minimum.
When we talk about loan to value versus loan to cost, one of the things is that the lender really wants to make sure that the asset is getting better. So, Fannie has the ability to roll in some rehab dollars into the property. Tell us a little bit about your perspective on acquisition price plus rehab dollars times 80%.
Exactly. So you're right on. Fannie will factor that in. So in other words, if you're paying $2 million for a property and you plan to put in $200,000 in capital improvements after acquisition, we'd look at that as a $2.2 million cost, and we could finance up to 80% of those total costs. Now, anything that goes in to planned CapEx, we're going to hold back from the initial loan funding, so we're going to make sure the dollars are there and that they'll be spent as they were intended to.
But these are not major rehabs. These are just going in and making some interior changes to the property, updating the interiors, maybe doing some exterior, making the property pop a little bit. So there's a limit on how much Fannie Mae, on a per unit basis, will put into the transaction. What's that number again?
It depends on the size of the loan. I've seen them go up as high as, say, $15,000 per door. It depends on the situation, but like you said, it's not for substantial renovations. That's more of an interim loan or a bridge loan, as we like to call it.
Yeah, again, the property has to support it, but we typically see anywhere from $4,000 to $5,000 a door. Again, this is not a major rehab, taking it down to the studs. We're just trying to update the property. Some of these properties were built in the 60s and 70s or even 80s, depending on the level of occupancy, whether it's been over-occupied. Sometimes these properties tend to have problems, so we're trying to put Humpty Dumpty back together again a little bit. Even though it is a stabilized property, we just want to make sure that $4,500 to $5,000 a door in rehab. And if you want to spend more money, you can, but that's coming out of your pocket, not so much Fannie Mae's pocket.
That's correct. Now, one of the good things is if you do elect to do that, and it results in improved income at the property down the road. Fannie and Freddie have a supplemental loan program, which is fairly unique to them in that if you can wait a year or more after you've received your loan and you can come back and demonstrate improved value at the property, we will agree to give you additional loan proceeds or a supplemental loan, based on that new value that you've created. So in other words, you can get some equity back down the road if the value of the property is improved. That's very unique to Fannie and Freddie. I don't know any other lenders that do that. So one of the good things is you can get equity back. You can also use that program if you sell your asset and the buyer assumes your existing loan. They can, at acquisition, seek and receive a supplemental loan. So let's say they're buying the property and the loan balance is 60% of purchase price. They can then lever it back up to, say, 75% of purchase price and do what I would call a more normal transaction with 25% equity instead of 40%. So you can use a supplemental loan in conjunction with an acquisition as well.
So in your, almost 30 years now, I guess, in the business, how are things have changed here in the last, say, 4 or 5 years versus, say, pre-recession? What are some of the differences in the Fannie Mae program or just lending in general that you've kind of observed?
One of the, I guess, good things about Fannie and Freddie is they've remained really, really consistent throughout my whole time in working with them. That 75%, 125 debt coverage has been a standard for a long, long time. It's also a standard that if you've got a default or a bankruptcy history, particularly if it's in the last 10 years, they're going to shy away from you. You're going to let somebody else take that on. So they've been very, very consistent. What I've seen here recently is, and let me go back, back in the heyday of the CMBS or the conduits, they got very aggressive. They were underwriting on future income and giving you credit for it in the loan today.
Sure.
I don't see that going on in the new version 2 or whatever you want to call it of CMBS. I think for the most part, all lenders have hopefully learned their lesson and stick to the basics of underwriting existing income. And when I say existing income, I'm talking the most aggressive is the current rent roll annualized. Typically, it's more like the last 3 months' income annualized. And then expenses, we look at the last 12 months. We put an inflation factor, typically 3% on most of the items there. And that's how we arrive at our underwritten income and our underwritten expenses, and then ultimately NOI, which is available for debt service.
Yeah. So you mentioned CMBS. Why would someone use a CMBS loan over a Fannie Mae loan or vice versa? What's kind of the differences between the two products?
It seems to me like CMBS will take on a more riskier situation or a riskier borrower. If borrower has a default or a foreclosure, sometimes you can get it done with CMBS, not with Fannie Mae. Fannie Mae treats like student housing properties a little more conservatively, let's say, than they do a standard multifamily property, whereas CMBS does not. So in that particular case, CMBS will usually win the proceeds battle on a student housing deal because they'll be more aggressive that way. But every lender has their niche where they specialize or where they're comfortable in, and sometimes it results in greater loan proceeds that way. So otherwise, I'd see CMBS and Fannie and Freddie as being, for the most part, fairly consistent with one another.
But there's some areas that Fannie may have an overexposure to the market.
True.
And so maybe a CMBS execution is a better way of doing it because there's markets that are called pre-review markets. Maybe you can talk a little bit about that. There's
pre-review and then there's concentration markets. And that's a real good point. Fannie and Freddie, like any prudent lender, monitors their performance of their portfolio that they've guaranteed. And when a market kind of goes in the tank, and it usually ends up in resulting in an increase in defaulted loans, Fannie, Freddie will remember that and put that market on pre-review. It basically means it's a yellow. It's not a hard stop, and it's not a wave you in green. It's proceed with caution. For instance, right now, Las Vegas is a pre-review market because Fannie recently, over the last 4 or 5 years, has experienced an uptick in problem loans there. Doesn't mean you can't get a loan done, and in certain cases you can get full leverage loans in good submarkets, but in other poorer performing submarkets, Fannie's going to dial back that leverage to, say, 65% instead of 75%. Also, concentration markets. For those of you listening in Texas, Midland, Odessa, oil-rich areas of Texas, Fannie has found that they have 3 out of every 4 apartments have been financed with a Fannie Mae loan. That's too big of a concentration, too much risk in one market. So Fannie's just kind of said, we're not going to do any new business there. We will refinance existing loans, but that's the only things we'll consider.
And even employment concentration. And so areas that may have too much military or maybe kind of like a company town that they have one dominant industry that a lot of the tenants work for, that they're sensitive on concentrations of employment.
Absolutely. And I would add, in today's world, oil and gas kind of boom towns that, kind of come up overnight. Certainly the Dakotas is one area where they need housing badly because of all the workers there. But the question remains, once the boom dies down, is there going to be demand for multifamily housing? So Fannie will definitely, and Freddie as well, will definitely look at employment concentrations. If there's one major employer in that town, they feel like there's a lot of risk associated with if that employer shut its doors, the demand for multifamily housing would go down substantially, and obviously defaults would increase. So that's another thing that's factored in is, they love diversified employment and markets that exhibit that.
So you kind of touched on the oil thing. So besides having concentration of either too many loans or concentration of pre-review or high defaults, is there anything that's come out for regulations or guidelines new due to the oil decline in oil prices here recently that you're aware of?
No, and I've talked about it in some recent conferences, and right now everybody's holding the course. Their eyes are open. For instance, in Houston, they're concerned about it, yet some folks also think it's going to affect single-family housing more than multifamily. The decrease in new jobs may drive people who want to buy a house to not and stay in apartments. So eyes wide open, but no, there's no limitations yet in oil cities, particularly like Houston as an example.
So you mentioned that in the last, say, 6 months or so, Freddie, on the small balance side, introduced a new product because they really were focusing on transactions of greater than, say, $10 million on newer properties. But now they've got a little bit more of an affordable mandate coming down the pike, and now this new small balance program. Tell us a little bit about the new small balance Freddie Mac loan. Happy
to. Freddie has jumped in with both feet very aggressively into the small balance arena. And though, again, they're there to compete with Fannie Mae, they're also there to compete with the national and local and regional banks out there. And they offer a product that is different than Fannie Mae's. It's highly flexible in the form of prepayment and the term of the loan. In general, it's like a 20-year term with a 30-year amortization, but you can pick and choose the front end of the loan, how long you want the fixed interest rate to be, 5, 7, 10 years. Then after that period's over, it converts to floating rate. And because of that, Freddie also marries into that flexible prepayment, such as if you did a 5-year fixed and a 15-year float, the 5-year fix comes with a 5-year step-down prepayment penalty, so it's 5% the first year and goes down from there, versus Fannie's more standard product, which is yield maintenance for the life of the loan. So if you did a 10-year loan with Fannie, you've got to maintain that yield if you pay it off to Fannie for 9.5, almost 10 years. So Freddie's is a lot more flexible on prepayment. There is no underwriting floor with Freddie, where Fannie does have an underwriting floor.
What does that mean?
It's I guess you call it an artificial rate that Fannie uses, because if you were to close a loan today, a 10-year loan at 4%, odds are down the road that interest rates are going to be higher. They can't. I don't believe they can go lower, but down the road, so you have a refi risk there. And so what Fannie does is throw in a kind of an artificial underwriting floor they use when they're sizing up a loan, because they feel like rates inevitably will go up, and they want to make sure you can pay off your loan when it comes due, even if it starts out at a very nice low rate. But Freddie doesn't have that, and that's an advantage. And typically what you'll see is on the small balance side, Freddie will be able to offer more loan proceeds because they're not limited like that.
Cost about the same?
Cost about the same, yeah, absolutely.
And going back again, we talked about that Fannie really is the Cadillac of loans, or has been for the last 15, 20 years. 30-year amortization, 10 or 12-year fixed interest rate term, the non-recourse piece of the transaction, rates in the mid-4s or so. You think Fannie and Freddie are going to kind of compete against each other in this small balance? And you think Fannie's going to start doing some more things that Freddie's already doing right now?
I absolutely do. Yes, they definitely will compete. Fannie had an off year last year. I'll just throw round numbers out, but they're used to doing $3 to $4 billion of small balance multifamily. My understanding is they were under $2 billion last year. They had, obviously Freddie came into the marketplace, and I personally know that Fannie is concerned about their new competition, and I hope to hear some competitive updates from Fannie Mae where they will improve their program and make it more, let's just say aggressive going after this small balance business, which is so attractive to the agencies now. It does not get counted in their quotas that they get from the federal government, which are both about $30 billion in financing a year. But anything affordable, anything that's small balance, and even a mobile home park does not count in that limit, if you would. So they're waving that business in. They're telling you they want to do as much of it as possible.
And experience level, again, Fannie and Freddie are not really for the first time out of the box borrower. Fannie's really looking for somebody that has experience. Same thing with Freddie too?
Yes.
So, Mike?
Yeah, touching on experience. So when we counsel people to get into, what type of is a proper loan or how to grow into the business, a lot of our listeners are either aspiring multifamily owners or haven't been in the business very long. So we've always kind of explained there's really two ways to get into the quote-unquote Fannie Mae country club or become a Fannie Mae eligible borrower. One is, like you talked about, buy a deal, borrow money from a traditional community or regional bank and wait a few years and gain your experience. Or the other is to partner with someone that already has experience, sign on as a key principal on a loan with them, and then you can wait a period of time, and then you're in the experience box is punched. So in your estimation, how long does it take if you were to sign on as a key principal with an experienced borrower on a loan, how long do you need to wait before you're ready to kind of come out of the box and then be a lead in your own deal?
I would say conservatively, if you've owned one property for 5 years, that demonstrates that you know what you're doing and you can keep an asset performing. If you own more than one, say two, if you own them for 2 years, that would be minimum requirements.
Would you say that's the same even as just being a key principal and you're on a Fannie Mae loan as well? Does that timeline kind of hold true there?
Yeah, as far as you being the lead, but again, as Paul mentioned, you can can buy that experience by partnering up with someone who has owned properties for those minimum periods of time. So you can get experience pretty quick if you're willing to partner up on, say, your first deal or your second deal till you meet those standards I mentioned.
Good. So what do you see going forward? We talked about kind of the current market. Do we see any sort of restrictions or expansion in demand? I know we talked about the small balance program, but is there any headwinds you see in constraining available loan proceeds with these programs?
I do not. Again, this is about as good a marketplace for multifamily, and I'm talking across the board, across the U.S. here, as I've seen in 30 years here. Do we have eyes open and looking at particularly new construction coming online? I know the Washington, D.C. area is probably the single market that I hear more than anything else of. Overbuilding has affected rents, has affected occupancy there. But any other market across the country, 99% of them are performing very well and expected, at least for the foreseeable future, rest of 15, maybe even 16, to continue to perform well with rent increases and good, strong occupancies.
Have you seen any? We have a lot of construction in our backyard in DFW. Have you seen any pressure on rental rates from the loans you guys are looking at due to the new supply?
Absolutely none. I see, concessions have basically all but gone. Rental rates are, up 3, 4, sometimes 5% given on the submarket, and that's expected to continue throughout 15. So good, strong occupancies with rent growth is kind of the state of the day today.
All right, now I'm going to ask you a loaded question. We've done business with you guys for a long period of time, and how do you feel Old Capital does in the multifamily business, and especially the transactions that we turn into Fannie Mae?
Loaded question, but one I can easily answer favorably for you, but honestly. You guys know the business. You know Fannie Mae as well or even better than I do. I'm here, obviously, to teach you about the new Freddie Mac product as well, but you know it, and when I receive a loan opportunity from you, I know you've looked at it through my glasses like I would, and it comes in typically very well qualified. No deal is, or very few deals are perfect, so we typically get right to the heart of the matter. What's the issue that could prevent us from doing this loan, and let's deal with that right up front so we don't waste people's time and monies, and if there is a hump or hurdle to get over, we attack it right then. So I love when a deal comes in from Old Capital Lending because I know it's been properly screened, it's typically well qualified, and it's an opportunity that I know has a very strong chance for a positive end result, which for me an end result is not only the closing of the loan, but a happy borrower who's getting good financing that's helping them either acquire or refinance an asset that provides good housing to people, and that's what this business is all about. And if we all can make a buck doing that, then that's great business to do. So, in general, again, I appreciate our relationship, and I know that Old Capital does a great job of pre-qualifying opportunities, and it's business worth working on once it comes in the door.
Perfect. Well, Tony, we appreciate your time today, and thank you so much.
You're very welcome.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.